Hello, my YouTube friends from Berlin, Germany. I hope you're all doing well. Let's talk about the elephant in the room today, Nextera Energy Partners, which had a pretty rough day yesterday. I'll talk about the reasons why. Should be a pretty interesting video, so stick around. Good morning. My name is Adam Kahn, and I'm the Rational Investor, and also this is Investing with Adam K. Forgive me, bad habit. I still think of the Rational Investor. Hope you're all doing well. I'm doing great. I'm here in Berlin, Germany. Just got here the day before yesterday. Yesterday we did a tour of the city. But before I talk about the trip a bit, because somebody said talk about it, let's talk about Nextera Energy Partners and what's going on. They got beat up pretty good from a downgrade by Barclays Bank. And I did a lot of reading last night and this morning to see what was going on and to delve into it a bit. So it seems as if they have a lot of convertible bonds that are coming due in late 2026, as well as going all the way into 2027 and a few years later. It's going to put a rather significant drag on the company, and unless they're able to improve their earnings over the next few years, what's really happened is the higher interest rates are going to impact the rates at what those bonds are borrowed at, impacting how much they're going to have to pay out on them. And they're either going to be put in a situation where they're going to have to sell off some assets, or they're going to have to lower the dividend to be able to make those payments. And part of the reason people get into the stock is those high dividend payments. Now, the thing is that they're not going to have to do anything anytime soon because, again, this doesn't start until late 2026, and currently everything is locked in. But it looks like they're borrowing at like a 4.25% rate right now, or 4.5% rate. And that's probably going to push up into the 7% range, maybe even 8% range with the higher interest rates, unless the Fed starts cutting in rather dramatically in a short amount of time. And I don't really see that happening. I'm not bearish on the markets. I'm not bearish on the economy. I don't really see the Fed being put in a position where they're going to have to cut dramatically anytime soon. So I have a feeling they're going to be looking at higher interest rates to continue to borrow that money. Or, as I stated, they're going to have to sell off some assets, which both of those cause the same issue. If they sell off some assets, they're not going to have the income coming in from those assets. And also, the other thing I read about that is it seems like renewable energy asset sales haven't been having the demand one would hope they are. So some of the companies that have already gone through some of that haven't gotten the prices they'd hoped for. Now, when I think back to the call that the guy from the company and I had, and his comments about being comfortable that their projections through 2027 are accurate, I'm guessing that's exactly why he was elusive about anything going forward, which is after that, they have some things coming due. They're not real sure where they're going to end up getting refinanced, and if the rates are higher, it could impact things. With that in mind, I think Barclays probably did an accurate description of where the valuation should be. Now, not today, because for the next year and a half, you really should get the yields they're stating. It's just drawing out about 90% or more of their income coming in and not building up enough of a base to be able to pay down some of this. So I think what ends up happening is they'll probably have to cut the dividend sometime in 2027, and therefore it'll be paying a 7% yield, let's say, and I'm just making this up and making a guess based on what I read, which would put it in line to where it's priced currently, maybe a little bit lower, which would then make sense to interest rates and what it's paying and what it's earning and everything else. But the current yield is probably inaccurate for what it's going to have to give going forward. All being said, it's not the end of the world. It's just not going to potentially be as great as I was hoping. My trader instincts really wanted to buy more shares yesterday when I saw it dropping the way it did. And generally, a lot of times, downgrades aren't necessarily accurate. Sometimes the information isn't great. Uh, Maybe this isn't either, but based on what I read from a few different sources, and I also want to thank Lance, who's one of my viewers, who sent me the first article, then had me digging a little bit deeper to see what was going on. And I used the site that he had sent it from, which is Seeking Alpha. to kind of do a little bit of the research as well as the news feeds that I read through. But I think the information's probably pretty accurate because it was the same thing coming a few different places. The other thing is Nextera Energy, who's their parent company, didn't really want to lend more to them, and they already have a substantial stake in the company, which I think also makes it more difficult for them to just move along and pay out those dividends. If they try to do that, they're going to downgrade their rating. That's going to hurt them as well. It'll hurt their ability to borrow and the rates that they'd have to pay. So I do think the better avenue when the time comes, unless they can find a way to drive higher income in the meantime, is that they probably will have to cut that dividend or sell off some assets, both having the same issues that it would. Now, it sounds like they could sell off some additional gas pipelines, and they were trying to go that direction anyway to cover some of the debt, but it really is they're taking on over $1 billion in debt over the time frame after 2027, and it's just a big burden that they're going to have to take on. And with rates much higher than it was when they started down the path they were going, I think it really impacts their ability to pay out the dividends they are. That being said, since I own too much of it, I will probably lighten up. I don't plan on getting out of the stock, but I really did buy too big of a position just basically because I was over attracted to the yield. And I have a little bit of a lead on it, so I might as well take some off the table and just have a more normal position instead of too big a position. Now, this is not financial advice by any means. You guys need to do your own research, and I would even suggest seeking out a financial advisor if you have questions or want to make those decisions. But I'm just sharing the information I use, and really, please don't make any trading decisions or investment decisions based on the information I'm providing. I'll probably end up moving those funds because it is in my dividend account into companies like Altria Group or British Tobacco because I still want to drive those yields. Um, Again, a little over attracted to the yields in that specific account. If you haven't been watching, I know for the ones who have, it's repetitive, but I do keep 3 different accounts. One that's like my main account, which I own my what I call forever stocks, the Amazons and Apples and Google and things like that. I then have this specific dividend account that I try to drive some dividend income to help pay some bills and things like that. And I get a little over attracted to yield in this account because that is my ultimate goal. And then I have a very small account that I am pretty active in. You know, I'll sell covered calls, I'll sell covered puts, I'll buy stocks still in short term, and I was kind of happy that I have some Tesla in there. It performed pretty well yesterday when they settled on Elon Musk's pay package. Fell off at the end of the day, but it actually gave me an opportunity to sell some covered calls on it when the market was up in the morning. Anyway, that's off topic. But those are the 3 different accounts I have. And part of the reason is I know, like a company like Amazon, I just want to own for the next 20 years. And I'll be too tempted to sell it when it goes up or potentially even when it goes down. I don't want to get out of those companies because I really think they're the best of the best. Um, there was a strategy actually shared with me that you guys might be interested in that I thought was a really interesting strategy on an investment where you could buy a 3-year CD to guarantee yourself 0% downside and then buy calls in the S&P futures or S&P like the spiders or the QQQ if you wanted to, dating out 2 years. So you still get the upside of the markets based on the call position and able to guarantee yourself no downside with the CD. So the numbers that we were using, and I don't want to say who it is because he's a financial planner and I don't know if it'll cover some problems with it, was essentially if you were using $200,000, you could buy an $174,000 CD, which would become 200,000 in 3 years. Therefore, you have 0% downside, and use the other 26,000 to buy 3 at the money December of, I think it was December 2026 calls that were at the money to be long the equivalent of 300 spiders, or I don't know if the Qs, I'd have to look at the math to see if that was the same numbers, but we were looking at the SPYs. but to be long 3 of the calls dated out that far for 2.5 years, almost the 3 years of the bond. If the stock market goes up, you get the benefit of being along those calls. If the stock market goes down, you have the CD in place so that in 3 years you've gotten your money back. Interesting strategy. I thought it was a really good one if you're a little bit conservative and have concerns that there might be a correction over the next few years, which I think there might be. There's a lot of things going on that are making people nervous. At the same time, I'm really bullish the market just because it doesn't look like it's had that peak yet. It seems to be drifting higher still. And when bad news has been coming out, the markets have been seeing that as good news and it's been going higher. And when good news has been coming out, they've been shrugging off the higher rates and continuing higher. And I think for good reason, which is higher rates means that the companies that are succeeding are probably going to continue to succeed because they'll be able to push through higher prices because there is some inflation. And then when the bad news comes out, the excitement is over that the Fed may be able to cut rates, which eases the ability to borrow. Both reasons make sense. Until there's a real slowdown that starts showing, I'm not really sure that I see the market start to correct. So as I stated, today I'm in Berlin, which is pretty cool. Each time I get to a new city, I'm really glad I'm doing these tours. So for those of you who like to travel, if you don't, I really suggest doing some sort of tour of sorts, whether it's using, I won't even mention any, I'm not selling any sites or anything like that, but we actually had a semi-private one yesterday at Berlin, which was super cool. When we're going around the city, he's pointing out these old buildings and stuff that I wouldn't have even noticed if I wasn't doing the tour, and I'll try to put a picture up, so I'll pause for a half second so that my yapping and maybe I'll say something overlapping, but insert picture. Anyway, so these buildings have little holes in them that don't really look like much, but those are from guns and big, I don't want to say cannons, but bigger guns that were being used in World War II. And unfortunately, when you really think about it, there was probably people being killed there and everything else. But it's amazing to be walking through these areas where you can see the buildings and the structure still standing with all these bullet holes all over them that make it really feel more alive in the sense that you can really picture how scary it must have been and what must have been going on during those times. We then got to see the city from a different perspective. Berlin's a big metropolitan city. It's very the structures are very, big, square, things like that. But when you get to delve into some of the older ones where the capital is and things like that, there are some beautiful structures mixed in as well. Haven't had a chance to really experience the food. I did go out for we picked up a pita at a pita place that was actually excellent. I don't know how attracted I am to some of the German food specifically because it's really heavy and everything else. I'm obviously pretty heavy, but I don't need to be eating, really big potato and meats and whatever else, and just not what I get drawn to. But the restaurants and everything have changed it. I haven't gone to it, but it looks like they have excellent Asian food. Um, and then when I saw a bunch of YouTube videos, I could see in the comments it became pretty obvious that like they have this one with the not schnitzel with the brats and things like that that they put a little bit of not really ketchup, but ketchupy type sauce, and then they sprinkle some chili powder on it. A place that became kind of famous. These things are very touristy, but I do want to try some brats. I actually got some when we were in Belgium, and I have to say they blew away the food in America. What really floors me is, we tend to stay at Airbnbs, although we're in a hotel now. Um, when you go to the supermarket, the fruits and the vegetables, and oh my God, the bread, it's so much better than home. I don't even understand why we can't get some of that stuff because it really is incredible. It's got that, like, I grew up in New York, and the bread in New York when I was a kid, it's got that nice, crunchy, hard outside with that soft inside. They have that at every supermarket, every deli, everywhere you can imagine all over Europe. And it just floors me that we can't do that anymore. On top of the fact, like things like strawberries are so good, they taste like strawberries. Um, And then even the vegetables, like got a few cucumbers, and they have so much better flavor than the bitterness of the ones at home. It's just so disappointing what we do in our farms and things to make things grow bigger faster than the food that they have here. And then it's so much less expensive. And I don't think that's just because of the strong dollar. I think that the supermarket and the food that people pick up to bring home really is that much less expensive. And if you are a drinker, my God, bottles of wines, I can't tell you how many of them they have for €3 or €4. That even if the dollar was back to $1.50, what are you talking about? $4.50 to $6 for bottles of wine, and like it's just amazing. Now going out is going out; things aren't so cheap or so inexpensive. Um, and then what I loved in Belgium is we went to this area, Bruges. Bruges is beautiful. Now it's very touristy and everything else, but it's got these beautiful castles, and I'll put up some pictures of Bruges as well. And I'll try to put up some of a few different places. But Brussels after the first day, because going through, we must have driven from the train station to our hotel, and it was kind of at night, a little bit of a sketchier area. But what an incredible city Brussels was as well. Belgium, we're finding out. And then the next one, we're going to Munich. I'm super excited for it. It looks really pretty. It looks kind of cool. So the trip's going great. I'm getting to spend some time with my family and my son and my wife, who I really enjoy. Like anybody, I make some jokes from time to time, but I'm one of the fortunate ones that I enjoy my time with my family. So it's really nice being on this vacation, getting to spend time with them, and then finding time to watch the markets. It's cool because the 1 a.m. pseudo open for the markets is at 10 a.m. here, and then the official open isn't until what it opens at 6:30 Nevada time, so that's 3:30 in the afternoon here. And then the markets close at 10 p.m., which is a really nice timeline for me to be able to keep an eye on things. Now, for me, part of travel is food. I like to eat. And what I will tell you here in Berlin, oh my God, the strudel and the pies and the desserts are incredible. Those were really good. Much better than what I typically find at home. And I was really impressed with that. We went out just for some coffee and got an apple strudel. And oh my God, it blew me away. Now, I knew that you should get apple strudel because it's from here and whatever else, but real apples, not that stuff out of a jar that comes as like a mix. And the pastry was like super soft and flaky all at the same time, which is a pretty impressive combination. And then the coffees here, like it kind of cracks me up because I was talking to the tour guide about it. Everywhere I've gone, the Starbucks are super busy, even some of them having lines like through the door. But I'm almost confused by it because there's so many unbelievable coffee shops that, forgive me, the coffee is so much better, where they're making the cream fresh and it just has that. It doesn't taste like burned beans and everything else. Yet Starbucks is still busy, which makes me feel a little bit more comfortable that in the next 10 years, company will do just fine. But it still cracks me up that so many people go to them, maybe tourists, but maybe just brand name, when you have all these options of these incredible places that make coffee everywhere else. But the desserts have been incredible. I mentioned it in the other video. Belgium's known for the waffles, of course, Belgian waffles, and then they're known for they're where the originator French fries come from. The story that I had heard, whether true or not, was Americans saw the fries. The people there were speaking French because they speak French sometimes in Belgium. So they assumed it was France and they called them French fries. Now, I don't know if that's true or just some funny story, but it's possible. But both the fries and the waffles were good, but again, not so good that I would be waiting on lines that are 20, 30 minutes long. It just wasn't that wonderful. And the funny thing is, my wife bought a thing of pre-packaged waffles just to have something from the store, and I thought those were really good. And the ones that were being made fresh, some of them were a little bit soft and not so great on the outside. There was one place we went that I thought it was better. And again, this was not some place that had some 20 or 30 minute line. It was just some place. And then the guide that we had said the best place to get it is just the little trucks. We just never had an opportunity, or we would have stopped and grabbed one out of there. And they're the least expensive place, but he said it all comes from a mix anyway. So most of it is the same as you'll find anywhere else, and the trucks do a really good job. And they charge like €1.50, where if you're in the touristy places, it was like €6 or €7 for the same thing. Anyway, before I yap for 45 minutes, do me a favor if you haven't already, hit that subscribe button, smash the like button, make some comments. Let me know what you think about my analysis on Nextera Energy Partners. Is it something to stick with, or is it something to let go? Am I better off just cramming all of my money into Amazon and not thinking about dividends or worrying about it? Because honestly, I think Amazon might be the best of the best. Again, have a great day. Thumbs up, like, subscribe. Let me know your thoughts, and have a good day.